right, next let's talk about this Royal Lepage report. Patrick, I like when the real estate companies always issue these reports. You always kind of get interesting data out of it, but you always kind of see, you also get their spin on it, right? Because, it's Royal Lepage that's putting out this report, and Royal Lepage is in the business of selling property. So, I always find the things skew in whatever direction they want it to skew. I'm not saying it's not a good report. It's actually a very good report. We know the people at Royal Lepage, they do very, very good work. But a couple of highlights, Patrick, that we want to point out in this report. First and foremost, they're saying 4.4 million Canadians, that's 11% of our population, own an investment property. That seems high to me.
Well, interesting is that when, over the past few years, we've watched these numbers, it doesn't actually seem high to me, given that I actually thought it was higher. Certainly over the past couple of years, there was as high as over 20% of people were buying investment properties over the past couple of years. So I think when you look at the bigger picture, 11% average out, I'm not really surprised by it. I think I believe the number. I think based on what we've seen in the past.
Well, it's interesting because I think it really speaks to the fact that Canadians understand that real estate is a fantastic wealth vehicle. It's a great wealth building vehicle. It's a great vehicle in order to capture some of that growth in the market. A lot of Canadians understand that, obviously. And one thing I do want to find out, Patrick, and it's curious on this one is, what do they consider an investment property? Because I would bet this is anyone who owns more than one property, which means people that own cottages, which are not investments. Let's be very clear about that. Unless you buy a cottage for the distinct purposes of getting an Airbnb in there, if you buy a cottage just in order to have a cottage, that's not an investment. That's a leisure property. But they probably lump those people in to this category, I'd assume, Patrick. I'm assuming that.
Yeah, I don't know. I actually don't know how they kind of differentiate. I mean, to me, it would be smarter if you're an investor. You wouldn't want to call it an investment property if you had a second property that you could refer to as a secondary residence. That would be a smarter move to make. Hence the thought process around property on the lake kind of thing. I don't know how I don't know how they differentiate that. I'm assuming they're going to mortgage brokers or banks or whatever. I mean, that's got to be in those kind of numbers that they're getting that. But at the end of the day, 11% of Canadians are, reaching that point of understanding that to create that financial future that they want, they believe in real estate. And of course, we believe in real estate. We've been talking about it for years. We keep beating that drum, keep moving forward, investing in real estate. Even through these times, there's still lots of opportunities.
Interesting that this report came out and said almost 1/3 of these, people who own investment real estate, 1/3 of investors in Canada, it's 31% to be precise, they've considered selling one or more of their investment properties because of the higher lending rates. This is interesting, Patrick. And if this number is a little bit, it's interesting, it's high. And I'm kind of, in my mind, I'll tell you what, I'm thinking, I wish a couple of these people would not just consider, but actually do it so we can get some supply on the market, so we can actually get this market moving a little bit more. But it's, people are considering selling because of the higher lending rates, which I think actually comes back to what you just said, Patrick, which is, in the last couple of years, we've seen reports that have talked about up to 25% of buyers being investors that are buying properties. And I tell you, Patrick, and we warn these people against this, but I've been dealing with lots of them at Vischer Property Group, trying to help them through these situations. But people that bought property 15, 16, 17 months ago at the tip top of the market, they are struggling with those properties now because they're having a very difficult time cash flow. They're floating these things. They're making bad decisions. And when you're under the gun of financial pressure and you have to generate a certain amount of cash flow, otherwise, you're in a bad financial situation. What that ends up happening is it compounds into bad rental housing provider decisions. You end up putting the wrong tenant in there. You end up not seeking the counsel and advice of property management companies because you're trying to save the 10%. All of this compounds, Patrick. It makes the problem even worse. And I'm helping lots of these people trying to clean up this mess because they bought at the top of the market. So I think that those people that are considering selling a lot of them are from that perspective.
Let's back up a little bit, JG. And so all of what you said is, really great point. I think there's a couple things. That 11% of investors, they don't, of course, identify some investors as the speculators that they are. So having said that, even the most sophisticated investors got caught a little bit with that shift in interest rates. Let's face it. But let's go back to some of the kind of economics of what we talk about in real estate. And as we look at a cycle, interest rates are an influencer. And in this case, it's a painful influencer for many because of that interest rate hike. However, knowing that this too shall pass. And, you have to look into the future a little bit, knowing that, yes, this is going to be a short term, and that doesn't mean a few months. It could actually be another 18 months. But ultimately, we have to believe strongly, and I do, that just given what's happening with the debt cycle, happening on a kind of a global macro scale, interest rates are going to have to come down. Because here's the real kind of crux of that conversation, JG, is that at the end of the day, our government is huge debt, far greater than the public debt, and they too are paying an increased rate. And so they have to service that debt. And part of our deficit is, in fact, servicing the reason for that deficit. A big part of it is servicing the debt load. So it's all to say this. Yes, it's painful right now. We have to be creative in getting through it. And ultimately, we can see the end result, which is those rates will come back down. That's my kind of thesis.
I mean, listen, interest rates are going to fluctuate. There's no doubt about it. So will they come back down? Yes. But will they come back to where they were at near zero? Absolutely not. So, but a lot of people have that in their head that that's where rates are going, is back to somewhat zero. These rates right now are normal. These are normal rates, Patrick. This back in the day. And when I say back in the day, I'm not talking about very long ago, 2015, 2016, 2017, 2014, 2012, 2010. All the time I bought real estate, these were the rates: 4.5, 5, 5.5 on some B. So it's like they're not that much higher than they always were. So will they come back down a little bit? Yes, but I don't want people thinking, oh, rates are going to come back and you're going to be able to get a mortgage at 1.6% like you could in 2021. That's not happening.
No, I don't see that happening either. And I'm glad that you clarified that. And there is a couple other things around that, JG, which is there's a part of it that we're operating on top of, many investors are operating on top of, and that is the fear of the interest rates spiking even higher. And, as we get into the rate debate shortly, we have to consider that that's what's keeping a number of people on the sidelines, is they want to wait to see what is going to happen with the rates. And I think that that's really going to cause some investors to lose some great opportunities.
Definitely recommend, folks, that you read this Royal Lepage report. Very fascinating statistics in here. One of them that I just saw again was 51% of investors who currently own an investment property, a residential investment property, 51% are either very likely or somewhat likely to buy another property within the next 5 years. So, interesting. The appetite is still there, is my point, Patrick. And there's no doubt that our economy and the entire system has been through tremendous shocks in the last 3 years. I mean, from COVID to the shutdowns, to the reopenings, to the money flooding the market, to the interest rate hikes. I mean, it seems like every 6 to 8 months, we're going through a major shock wave. And I'm hoping, this is a hope, that we're almost at the end of these major shock waves. We'll see which one is the next shock wave as the market kind of just settles down a little bit.
No, it's a good point. And I think that it will start to settle down. But, this goes back to what we've said many times as well, JG, is that for those sitting on the sidelines, continue to look for opportunities, because those speculators that are feeling the stress and the pressure, there'll be some opportunities that if you go looking for them, they're already there, by the way, to actually get in the game.
100%.
If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click here. If you want to see the entire show, click there.